Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Today we're going to talk about the Walt Disney Company. Disney's a behemoth. This is their most recent 10K. We're going to go through it and we're going to look at two ways to value Disney, a free cash flow method and a market multiple method. And come up with what we think the stock price is going to be, and we'll compare it to the market and see what we think the long-term financial outlook for Disney might be from a stockholder perspective. Now we look at five attributes for a solid investment. We look for top-line revenue growth. We look for strong free cash flow that's increasing. We look for good earnings that are also growing, solid balance sheet, and finally, the investment needs to be well priced. We can have a very good company that has all four of those, but it's too expensive, and right now we would pass on it. But if you can find a good investment and you wait for it over multiple years, in some cases, it will eventually come down and you can buy it. Certainly at this time with the market fluctuations that we're seeing with coronavirus, there are deals to be had out there, and it's time to put some money to work. Let's take a look at the Walt Disney Company. The first thing I want to talk about is the overview on the very first page of the 10K. It's important to note that in March of 2019, the Walt Disney Company acquired, in one of the biggest mergers ever, the 21st Century Fox Corporation for $70 billion. That was both a combination of stock that they paid and an assumption of debt, and we'll get onto that in a later part of the video. But it's a very big opportunity for them. They'll get a tremendous amount of content from this, and it's another chapter in a series of acquisitions the Walt Disney Company has done to build out their portfolio of brands and content. If you recall, they acquired the Lucas Company many years back, Marvel, and then recently the 21st Century Fox Company, and each time they have done so, they've been able to take that content, in the Star Wars instance, and make it accretive to earnings, increasing the number of videos that they publish, pushing the products like T-shirts and consumer product goods, expanding onto their experience centers. So the Walt Disney World or Disneyland has a Star Wars theme to it now. They have been able to take what was a particular movie or a book and widen the revenue generating possibilities, which is very commendable, and it's something that I think they're going to be able to do with 21st Century, because we have evidence that they've done it in the past for success. The other thing that they have done is they've launched the Disney Plus. So Disney Plus is their online direct-to-consumer paid subscription service. It's something akin to a Netflix or Hulu that Disney is going to be using to drive their content direct to the customer and get subscriber revenue, which is going to be very key to bolstering their earnings and probably guide the company to the next decade and beyond. It's also important to note that if you read through here, you'll see when they bought 21st Century Fox, they got with that a step up in their Hulu equity stake. They now own the majority stake in Hulu and have consolidated Hulu onto their balance sheet and financials. You'll see a couple changes there as a result of that. But all around, very consistent with what Disney has been doing in the past. And if it's priced well, we'll see what that bodes, if it bodes well for the future. So this is the first overview, gives a landscape of recent changes. It's on page 1 of the S1 of the 10K. But let's zip through, and I want to talk quickly about page 82. 82 is a very good page. It breaks out the operations of the Walt Disney Company into different buckets. Because they're so large and they have such diverse platforms with which they generate revenue, it's important to get an understanding of where the business, how they generate their income. So let's go to page 82. Here we go. What I like about this is it gives you several years perspective, and it's basically the P&L broken out by by division. You've got your media network, your parks and experience centers, studio, the direct-to-consumer, that'd be the Disney Plus, and a couple other, for a total revenue of roughly $70 billion. You'll see that the direct-to-consumer is relatively small at $9 billion. Analysts and people in the future are betting on this number, that it will grow and it will grow rapidly. The other thing to take note is the parks and entertainment area at $26 billion is a large piece of their revenue. I think it's something in the name of 30%, if I got that. 38% of their total revenue comes from the parks and the cruises. In light of the coronavirus, I think you need to sit back. We're going to go through the math exercise here, but you need to sit back and think, will the coronavirus, with the social distancing that we're currently experiencing, have an impact on the number of visitors to these facilities? They are extremely expensive to maintain, to build. Margins are okay. So you might want to have a framework of, do you think that's going to go back to normal? And use that when we look through these numbers. But it's important to note, we'll talk on it later. Revenue basically by division. If you scroll down, you get operating expenses. One thing that I think is interesting here, there's a little degradation in the operating margin. So you go from 27% operating performance here to 21%. So a full 6% degrade. That could be one of two things. One, the acquisition of 21st Century Fox and the Hulu piece. Hulu's burning cash basically, and now that they own a majority of it, they have to consolidate all those losses or all those higher OPEX costs onto their balance, onto the P&L. Also, they're spending money developing the direct-to-consumer, the Disney Plus. So right now the margins aren't there. That's probably what's leading to the decline to the 21%. I'm just taking 14.8 and dividing it by the 70 billion for the margin. So a little margin degradation there. We can talk about that in the future, but it's something to watch out for. The next thing on this page, which I think is really interesting, is the Capex. So remember, when we're looking at cash flow, we're taking operating cash flow, we're subtracting it from Capex to maintain the cash flow that we want to come up with a free cash flow number. And interesting here, their Capex is roughly $4.8 billion in 2019, and the vast majority of that, right there, goes to the parks and entertainment, the parks and experience centers, which makes sense, right? Disneyland, Disney World, the cruise ships, those are massive enterprises, and it takes a tremendous amount of cash to keep them running. So that's a general overview, very general overview of the P&L and some cash by division. Let's go through now and look at what we think the operating cash flow is and where I got that. So I'm going to go to the cash flow statement on page 77, and then we're going to look at this over time. Here we go. Cash flow statement. This is the operating cash flow right here. Cash provided by continuing operations. We're going to pull these numbers. You'll notice that that it is growing, $12 billion, $14 billion, and it takes a hit here at $5.9 billion. What happened? A couple things. One, there is a large tax payment, $6.5 billion. There wasn't too much information in here. I would have liked them to break that out a little bit more. But the most I can tell, they had an estimate of what taxes should have been. It was far too low, despite the reduction in taxes that we've had the last couple of years. They changed the tax rate. They still had to make an adjustment to those taxes. So I will add that back to normalize it, because I think it's a one-time item. And then second, the gain on the acquisition here. Now that's something that's a gain that's on the P&L statement, but it wasn't an actual cash gain. It was the effect of pulling Hulu onto the balance sheet entirely. The value of Hulu has gone up since Disney first bought in. That is a gain, and that they're recognizing on the P&L. They're removing it here on the cash flow statement. So this is the cash flow statement. We're going to pick up with the $5.9 billion. We're going to use the Capex here of $4.8 billion for ongoing Capex, and their debt borrowings was basically zero for the last year in terms of what they issued and what they repaid. Let's go to the cash flow statement. All right, there's the cash flow from operations number that you saw earlier. There's the Capex and the debt payments, the net of basically issuing debt and paying down debt, or issuing debt and paying down debt. I have not included the debt that they have assumed when they bought 21st Century Fox. You'll see that in another slide. This is basically the debt that they would generate or issue on their own from their business operations. So what do we see? First off, cash flow from operations here has been growing, which is nice to see. Capex is very stable. Again, most of it going into the parks. Debt payments, it looks like they've issued debt in this region. That's probably for the acquisitions that they have been doing for, again, I referenced Lucasfilms and the Marvel collection. The adjustments, I didn't adjust anything historically. I did make the one adjustment for taxes, and what that does is helps normalize the free cash flow here. It is down a little bit from historical, but I think, again, there were a number of costs associated with the acquisition of 21st Century and the margin impact that we referenced earlier. I think that's one time, but it's going to be a risk we're going to have to assume if we buy into this, that the Walt Disney Company is going to be able to increase margins with Disney Plus, with Hulu, and at Fox over time. Shares outstanding, they did issue a large amount of shares when they bought 21st Century Fox, roughly 159 million shares. The neat thing when they bought it is they bought it kind of at a peak stock price for the Walt Disney Company. So if you're gonna use equity when you buy a company, it's better to use it when your equity is already richly valued. And at $135, this is September and average. They bought it, I think, in I think I said March. So someplace in this range, they were issuing the equity. But still, a nice value for the equity. So when you give that to the owners of the 21st Century Fox in your exchange, you're really valuing. You're giving them consideration that might be higher value than normal. So that's good. Yield, average yield 5.8% over the decade. That's a strong free cash flow yield. I like to see that. That's excellent. And then the growth rate. They've grown this yield over time on average 15% annually. And again, I'm just looking at the change in the free cash flow per share over time. I think I said growth in the yield. That's the growth in the free cash flow per share. What does this look like if we stretch it forward and go to a valuation on this free cash flow method? So move forward in time. I want to note before we do that, here it looks like the earnings drop, the free cash flow per share is actually down for the last several years. Again, that's probably because of costs associated, the margins on the Fox business and on the Hulu business are lower than the legacy business, and Disney's going to have to work to improve that. And if we buy into the vision of growth in earnings, we're saying that they're going to naturally do that over time. So we're going to pick up on that 4.28 number as we grow, and we're going to grow. We're going to pick up the growth 15%. I'm going to keep the growth at 15%. Why? Because I don't think they deserve a haircut. This is not 30%. They've been doing well despite the recent change here, which I think is margin based. I think over the long term they should be able to average 13% on this free cash flow over time with the recent acquisition of that the Fox and then the Disney Plus I think it's reasonable to expect someplace in the low double digit of free cash flow generation over time. So that's how I get to a value here of $250. I'm basically taking the yield on the free cash flow per share to get $250 over a decade. Let's go look at another method. So that's free cash flow, which again is positive and growing. One of the hallmarks that we need to see. The next one is revenue, and you can see here revenue has been increasing. It's not really doubled, almost doubled in the decade. I would have liked to see a little stronger top line growth, but that's definitely moving in the right direction. EBIT, earnings before interest and tax. Disney does a good job with their 10K on this. Let's go to the P&L. What I liked about this is how clean it is. So here's the P&L, top line revenue, $69 billion. Costs, they break out depreciation from their production costs and service costs, which I really like. It makes it easier to churn through the numbers, and they put it as its own separate line item on the P&L. Generally, you have to go to the cash flow statement to get it, but it's nice when they break it out on the P&L. Kudos to them. SG&A, total costs, a couple things. One, impairment. There was an impairment charge when they did the acquisition of 21st Century. That's a non-cash item, and it hurt earnings, hurt EBIT. They've got a couple other items here. Let's see, other income. This is that gain on the markup of Hulu that I was talking about. It's an accounting gain, but it's not cash. Second, we've got interest expense, which we will exclude because we're trying to get to an EBITDA, and then equity income, which we generally exclude because we're looking for the business income, not income from other investments that they've made in the past, other non-majority controlled investments. So what I do is I pick up this number here, continuing operations 10.913 billion, and I'm going to add back taxes. I'm going to add back the equity. I'll add back interest. I'll subtract this non-cash gain, and I'll add back the impairment charge. This impairment charge I add back. These I do not. There's always a little impairment that they seem to incur, but that seems like a large one-time item, and I don't want to punish the EBITDA for that one time because I'm going to take that and string it into the future. So here we go. There's the earnings before interest and tax. Again, I've made some of those adjustments that you saw me go through. One of the reasons I like the 10K the way they do it is that these are all summed up right here. It's this minus that, basically plus any of those to get this number. Sometimes you'll see they'll do, like here you got income or bracket a loss. That can be confusing if it's, do I add that back, do I subtract it? But basically they're just taking a summation of all those lines, which makes it really easy to add back. So going back to our EBITDA calculation, this is the one-time adjustment for the impairment. I've added it back, and it seemed to have normalized the EBITDA in the pattern. Not too much growth here, so I thought that was interesting. Over the long term, it has basically when they bought the properties when they bought the Lucas and Marvel and so forth, they were able to get incremental step-ups, but it's chunky, and they have to go buy other assets in order to grow that line. I think that's probably a small risk that they have to be able to find new content to put into their pipeline, much like Netflix might have to spend a lot of money on production, to Disney too, but to produce video you have to buy scripts, hire actors, producers to build content, or go out and buy it. Those are the ways that they can really move their revenue needle, or in this case, EBITDA needle. But here's the EBITDA that I have. You can see growth rate, average growth rate, 7%. A little less than what we say our growth rate was growth rate, 15% of free cash flow, but generally in the right direction. It seems like we're hovering around this low double-digit range of 7 to 15, maybe 10% seems like a decent range long term. Let's talk about enterprise value. Enterprise value, debt. I want to run through the balance sheet quickly for you on the Disney, just because there's a couple things here. For starters, if you can see, yeah, here's their short-term portion of borrowing. So that's the debt that's due this year. We're going to come down to borrowings. Borrowings is actually the long-term debt. They call it borrowing. I don't know why it's long-term debt, but they call it borrowings. And then you'll see other long-term liabilities. I'm also going to include that. If you read the footnote, you'll realize that is related to pension liabilities and other legacy retirement plans or obligations that Disney has to fulfill. And as a result, we want to include that as debt. That is something that the government will make them definitely pay back to their former employees. So we want to make sure we're mindful of adding that back in. The other thing I want to note is the big jump in debt here, from 17 to 38 billion. That's the assumption of debt when they bought 21st Century Fox, $21 billion of assumed debt. And when we go back here, you can see that 20, fine, easy. EBITDA multiple 2 coming down 1.5, and then it jumps 3.8%, jumps to $60 billion. That's a big move, and it's a risk to you and I. Remember, as a stockholder, we are last in line. If there was ever to be a bankruptcy or a problem situation, we are the first to take the hit to protect these guys. It's in the documentation. So when you start seeing this big move, take a pause and realize you've increased the risk more than 2 times. If you're at 1.5, you go to 3.8. That's more than doubling. Maybe on the average, you're kind of closer to 2, so 1.5 times increase in your debt load relative to EBITDA. That's significant, and it's something that you need to be watching next year. I expect them to pay that down heavily and get back into their long-term range. But it seems like it's a risk that they're willing to take. The content should be valuable enough, and I'm sure they're aware of it. But moving forward, so you've got the debt. I did not find any cash on hand that I thought was excess. Disney does not store cash like some of the other companies that are out there. The cash that they have on hand is their working capital cash, so there's no excess. Market cap, again, share price in the September range, which is their fiscal year end, times shares outstanding. Add these up, I get enterprise value. Enterprise value, again, is the value for the entire business. If you wanted to buy Disney, everything, lock, stock, and barrel, you owned all of it, you'd have to pay off the debt holders, and then you'd own the company free and clear. And we look at companies this way because the debt load that they take on matters. If you only look at the stock price, if you only look at the market cap of the company, and that's when you invest in, you're forgetting the piece of the second side of the equation, which is the debt, which needs to be paid back. And if that debt gets too high, you're not going to see it if you're just looking at the market cap or just looking at the stock price. You need to add the two together, look at the enterprise as a whole piece. That's what enterprise value is. That's what professional investors will do. Enterprise value divided by EBITDA, which is a proxy for cash flow, tells you how many times of cash flow the business is trading at. Here, 12 times. It seems low to me. For a company with a solid 5% plus yield, decent, if not strong revenue growth, consistent EBITDA, if not it is growing, albeit a single digit, it's growing. That seems a little low. I would have thought it was higher. Certainly it's higher recently when they bought the 21st Century Fox company and the Disney Plus announcement. It seems like investors are giving them credit for those earnings to come. But I thought this was interesting. Kind of low, 8.5 times, that seems crazy low in my mind for a business of at least back then 40 billion of revenue and 10 billion of EBITDA. That seems really cheap. This might be a little on the high side for the 18 times, but that's the range. Let's take this and go forward and come up with a future value. So what I'm going to do is I'm going to pick up the EBITDA of $16 billion, and we're going to grow that in the future. I'm holding 7% constant. All right. Normally what I'll do is I'll take the growth rate and I'll haircut it and I'll bring it down over time. But this growth rate wasn't all that high, and bringing it down to 3% or 5% so early on seemed a little too conservative. That they should be able to grow earnings with the Disney Plus, with the Hulu, with ESPN Plus, online, and with the new content. I'm expecting them to average 7% over this period of time. Again, free cash flow average is 13%, 7% here. I think that's close enough, right? We're hovering around a 10% average growth rate. Then what I'm doing is I'm picking up the 12 times average EBITDA multiple times my EBITDA for a future enterprise value of $377 billion. Debt, using the same debt ratio, it's basically an average of what they've had in the past. So that means that this number would come down, this debt load would come down, and they'd be in this range that we've had historically. Fully diluted shares outstanding, $1.656 billion, give me $191 a share. Two different ways, pretty different, well actually not that different, of forecasts, 250 versus 190. Let's look and see. Here you go, you've got the difference between the two. You got 250, 190. Weighting, you can assign what weight you want to come up with $220 as a long-term target. If I throw that into a IRR calculation, what does that mean? Here, picking up my earnings for the 10 years, the free cash flow that we estimated, pushing that into forward so that we receive it. Current stock price is 105, which is down significantly from where it has been in the past. Certainly when they bought Fox, I mean, think of it this way. If Fox accepted $135 roughly a share when they sold Fox to Disney, they would much rather have done that at $105 a share, because that means their stake in Disney would grow. So it's come down. You've got an opportunity now to buy what Disney purchased in Fox at a lower price, which is interesting. Long-term, 220 would be the average to give me a forecast cash flow. This yields me 16% IRR. That is an annualized rate of return. So that means I put in $105 today with one share, and every year that 105 makes 16%, and that 16% compounds over time every year for an eventual return of $200 of total cash on my $105 investment. That's how the IRRs work. That is basically a 2 times cash on cash return over the decade. So what do we think? Disney, 16% return. That's basically a market return for what has historically been a slower growing, conservative blue chip staple. Is now estimated to grow around 16%, which is slightly above what the S&P 500 will do over any given decade. That seems nice to me. I think that's a good entry point. There's a couple things I want to note here. One, again, this is a math exercise, right? I'm punching in numbers. There's a little squish here and there on the numbers, and I'm just stringing out some assumptions over time to give us a proxy. You need to sit back and think, in the future, is Disney's business going to change materially? It might. The cruise stocks are being absolutely demolished right now. And if social distancing continues to be as prominent as it is right now while we're on a stay-at-home order, that could be a significant problem for 38% of their revenue. So I think that's a big risk. Second big risk is execution risk. So Disney's putting a lot of money into the 21st Century Fox acquisition, and they're putting a lot of weight behind Disney Plus and Hulu. They have never been in that space before. They are not a startup. They have a lot of legacy or institutional procedures, and they might be very, very slow to execute or execute poorly. And maybe a startup is easier to capture the dynamic nature of online video production. But then again, they have done very well in previous acquisitions, monetizing both Lucas and Marvel. So I gotta give them credit that they can pull it off. Second, I will note that Bob Iger, thank you for your decade of service, probably more than that. Tremendous CEO, has done an amazing job, and certainly the guy instrumental in buying Lucas and Marvel and going after those acquisitions. He has decided to move on. We have a new CEO. We need to watch how he integrates, how the business changes under his leadership. I think that's a risk too. Overall, I think that those are your risks. The other one is paying down that debt that we need them to pay down. What's the upside here? So, like I said, I think this is pretty conservative. We're taking historical growth rates. We're even shrinking them a little bit. If Disney can pull off Disney Plus and really accelerate growth and take a bite out of the Netflix of the world or the Amazons of the world, then these numbers could turn out to be conservative, and we could see Disney Plus grow kind of parabolically like some of the other subscription services businesses. And I will say that from a defensive position, having a subscriber base pay you monthly is incredibly defensive and very sticky from a product set, from a cash flow standpoint. So I'm curious to see how that pans out. Lastly, I think with the digitization of entertainment, Disney is going to get a whole new data stream on what their customers are and who they are, where they live, what they like to view and look at. And I think Disney is going to be able to take that and hopefully use that to enhance their theme parks, their cruise ships, the consumer products that they offer. So I think there could be upside here, beyond what we have here. All in all, I'm going to give it a good rating, right? Let's go through our criteria. First, top line revenue growth. Check. Great, I have a lag here. Well, that'll catch up eventually. Top line revenue growth, check. Strong cash flow yield, I think it was 5.8%. That was excellent. We've got earnings growth. You saw the EBITDA grow, stabilize a little bit, but it's still going in the right direction. Strong balance sheet. I will caution that, but I'd like to see it a little stronger. But I get why it's where it is, because they made the acquisition for the content to push the business forward. So I'm willing to give them some street credit, if you will, that they're going to pay that down. And the last and final one is well priced. I think this recent disruption gives a very interesting entry point for Disney, with a market perform like we're saying at 16% and possibly higher over the long term if they're able to properly execute on the Disney Plus. Another interesting thing is the ESPN. We've got online gaming coming through as people watch online games. Maybe they can step into that as well. That could be another big thing. But all that speculation. We're not buying on speculation. We are valuing the company on what they've done in the past and what we believe they can rationally do now. And if that's a solid investment and they exceed it, more the better. I look forward to your comments. Thank you for the time. This has been a rational investor's approach to the Walt Disney Company. My name is Cameron Stewart. Thank you very much for joining. Please comment, please subscribe. I love hearing the feedback. Thank you very much. Bye-bye.